India's consumer price-based inflation, which had been steadily rising for the past few months, cooled to 6.77% in October after hitting a 5-month high in September. Did you know that the stock market is sensitive to inflation data? That's because inflation numbers can influence interest rates. How, you ask? Well, that's what we are here for. In this video, we help you understand how inflation and the stock market are related. Okay, so this is something we hear very often. Inflation is bad news for the stock market. Now, why is that? If inflation rises over a sustained period, the RBI tries to cool it by raising the interest rates. Not that raising interest rates is the most effective way to quell inflation, but it does help reduce demand to a certain extent. Inflation, after all, is caused by more money chasing fewer goods. So a higher rate of interest on auto or home loans, for example, may force a section of consumers to postpone their purchases, which translates into less demand for cars and homes in this case. Of course, that spells bad news for auto companies and even home loan companies. Moreover, fewer home loans or fewer homes sold means less demand for steel and cement, so on and so forth. Similarly, lower demand for cars means less revenue for companies which supply parts to auto companies. That's not all. Remember, companies too borrow money to run their operations. If they have to pay higher rates on their loans, it means less profit. And when profits shrink, companies may cut back on expansion plans, which could lead to a slowdown in economic activity and or reduce the dividends they pay to shareholders if at all it's a dividend-paying company. Now coming to the big question, why do share prices fall? The market values a stock based on its ability to grow profits. Now, if a company that consistently sees a 20% growth in earnings every year will be valued higher than the one that is able to grow its profits by 10% annually. So when profits fall, investors start pulling money out of the lower rated stocks and look for other opportunities. Wondering where investors park all that money? When interest rates are rising, FDs suddenly become very attractive as they start giving out better returns. Wealthy investors look at something known as risk-free rate of return and how much the stock market can offer above that. Bank FD returns are as good as risk-free unless there is a run on the bank. Say a one-year bank FD offers 4% interest rate while the Nifty is rising at 12% every year. In such a situation, investors would like to put their money in the stock market. But if a one-year FD is offering 7% interest and the Nifty is rising just 9%, in such a situation, some investors may prefer a 7% return without losing their sleep than taking stress for that extra 2%. When more people start thinking that way, money begins to shift out from the stock market to bank FDs. Does that mean inflation is always bad for the stock market? Well, not necessarily. Within an acceptable limit, inflation indicates a growing economy. High inflation is bad for the economy, but moderate inflation keeps demand for goods and services intact. If companies expect demand to be good, they will produce more. The higher the profits, the greater the value that the market will assign to the stocks of those companies. Hope this gives you more clarity on the correlation between the stock market and inflation data. Don't forget to like and share this video and subscribe to our channel for more such explainers.